Hi guys, this is Crowd Investing. Today we're going to talk about the secret of selecting the right ETF in your investment portfolio and what kind of the strategies can you actually use to invest in the ETF. So, we had to know what is the ETF first. You can see that from 2003, there is only 123 ETF, but in 2020, there is more than 2,200 ETF. There is a lot inside the market. So a lot of people they are confusing what kind of the ETF that I should investing in, and then how to select the right ETF, what is the criteria. So all this we'll cover in today's videos. Okay, a few minutes to know what is an ETF. The ETF is actually a basket of the asset. The asset can be the stock, bonds, currency, commodities, and so on. And then they are actually track the underlying index. So what is the basket? It's like this. The basket can be have the Facebook, Alibaba, Amazon, Microsoft, Google, and Apple. It depends on what kind of the ETF you are buying. And then ETF is actually different from the mutual funds, and then ETF is listed in the stock exchange and tradable like the stock, like you can buy and sell uh, immediately as your preference. It's not like the mutual fund. Mutual fund you can only buy from the insurance agent or the banks. It's totally different things. Then the ETF actually own the underlying asset. The asset, just now I mentioned, can be the stock, bond, currency, or commodities, depending on the ETF. And then they divide the ownership of those assets into the share. ETF, the shareholder is entitled to a portion of the profit and underlying asset values. What does it mean? Okay, take the example of QQQ. QQQ, right, the top 10 holding is Apple, Microsoft, Amazon, and so on. So QQQ actually buying the Apple share. So once they buy the Apple share, put inside the ETF, then you buy the ETF means that you are actually own a certain part of the Apple share once you buy the ETF. So you are the partially is the owner of the shareholder of the Apple or Microsoft Amazon if you buy the QQQ ETF. Okay, so we're going to see will you be profiting is in just investing in ETF. So this is the research that I have done. So in the S&P 500 ETF, the SPY, in the last 93 years, right, the gain and loss is actually is almost near to 100% winning. You can see every column is 30 years. So if you invest in the SPY 30 years, then you are impossible to lose the money. You see, average 1 year is 11, 12, 13, or 14. So averagely it's about 12% a year if you can invest in the S&P 500 for just 30 years. Don't do anything, just invest. Every year around 12% return is fantastic. So this is the financial calculator that I am using. So I put the average is 12% return, and then the period is 30 years, and then annually, let's say you invest $4,000 annually, after 30 years with 12%, right, your value is actually about $1 million. So means that you are just investing in the S&P 500 ETF, you can get $1 million after 30 years. Don't need to do anything. So we have to compare a ETF to the mutual funds and the unit trust. Okay, the ETF is just like I mentioned, it's like the stock you can long or short at the same time. Mutual funds cannot, you can only long. Then it continuous pricing. The mutual fund is the fund's net asset value is calculated at the end of the day. It's totally different. Then the low expenses ratio, and then there is a sales charges and management fee. Because all the mutual fund they will charge you roughly about 1 to 3% management fee yearly. No matter you are profiting or losing the money, they will just charge you only. Then this one is listed in the stock exchange. You can buy and sell as your preference. This one is only you can only buy through the bank or insurance company. So there is advantage and the disadvantage of the ETF. The advantage is the you can be diversification, means that you can buy the ETF that is including a lot of the stock, so that you will reduce your risk. There is less time involved because you don't need to do the research of the individual company. You don't need to read their financial report. There is a disadvantage also. Sometimes the ETF may be over diversification, means that they bought too many different small companies, then it's not well, it's over diversification. Then sometimes it's lack of rebalancing because sometimes the ETF may be hold certain company too much and hold others company do less. Example of QQQ, they hold the top 10 company is too much than others company. And then ETF is slower growth. You don't expect the ETF can give you a 20% return a year. It's very difficult. So it slowly grow. So okay, right now we know what is an ETF. So we come to selecting the right ETF in your portfolio. So the first thing you have to look at is the ETF, the fund size, and the ETF fund management company. Because we want the fund management company is big and then is very stable. So the reputable company is the BlackRock, Vanguard, State Street Global, Deutsche Bank. Yeah, then you must ensure that the fund size is very big. Those popular ones should be alright for you. Then the component of the companies being whole and percentage of allocations, so that you have to know how many companies are inside the fund and how they allocate. Example, if let's say this ETF have allocate 20% in Tesla, means that they are over allocation in Tesla. It's not diversified enough. So you have to ensure that each company is well allocation in the ETF. Then does the fund hold a share of the underlying stock? Because some of the ETF company, right, they are not actually buying the stock of this company. They are buying the options. So those things is they are not actually holding the underlying asset. They are just holding the option contract. So you have to avoid those things. So you have to avoid the synthetic ETF. Because if there is something wrong, this ETF is not actually holding the underlying company. So we have to avoid all this just to ensure that the company are actually buying the real company share. There is an expenses ratio. So you have to know that ETF also have the management fee. So you have to know what is a management fee. Of course, the lower the better. Then the average volume of the everyday the trading, the higher the better, means that the higher the volume means that this ETF is really well known, also very liquid for everyone to trade. Then is the ETF have the options or not? Options means the option trading. So ideally don't have also never mind, but just that to ensure that the first 4 points is meet. And then what is the past performance? You can look at the ETF charting, look at the last 20 years, is it in the uptrend or moving sideways or moving downtrend? So we had to ensure. So these are the 6 points that we had to know before we are buying the ETF. So it's like individual stock. You have to do the research. ETF, you also have to do some of the research. But the good thing is ETF is more easy than the individual stock. So actually you can just read the ETF website, then you can have all those details already. So what is the types of the ETF? There is a lot of types. They have the market ETF, sector ETF, bond, currency, commodity, inverse ETF, and leverage ETF. So the only thing that don't touch is the leverage ETF, because this is a very high risk. If you are the newbie or you are the don't know how to invest in the market, then do not touch this one. Yeah, this is a very high risk. And then due to the time, we will only go through the market and the sector ETF, because these two is the most popular and the most suitable for the normal investor. Okay, what is a market ETF? Market ETF that there is an ETF that track the overall market index. So there is a QQQ, SPY, and Dow Jones. These all are the famous one. You can just invest in all these, then you can be very profitable also. You can see that in the last 5 years, the QQQ actually grew 200%, SPY 99%, Dow Jones 94%. Dow Jones and SPY is actually moving quite similar. Yeah. So there's a sector ETF. There's a lot of the sector. You have the healthcare, finance, basic material, energy, industrial, technology, utilities. So you have to know what kind of the ETF that do you want to invest. So for the healthcare means that this ETF is holding all other healthcare company. So if you want to diversify, right, you can in your portfolio you can include the healthcare, finance, and then technology. Then you can just allocate your percentage to each of the ETF. So what is the strategies to invest in the ETF? So after so many research, right, I found out that the two best strategies to invest is dollar cost averaging and buy in the dip. What is dollar cost averaging? Dollar cost averaging means that you invest a fixed dollar amount at the regular basis, maybe a monthly, quarterly, or half year. So your holding period must be minimum 5 to 10 years. Of course, the best is 30 years. If you hold for 30 years, you are impossible to lose the money. You are confirmed almost 99.99% profiting if you hold for 30 years. Buy in the dip is you just put the limit order in all the moving averages or support level. You just put there using the good deal cancel GTC, and then just put there, no need to do anything. If the price drop, it will auto trigger, and then the holding period is also minimum 5 to 10 years. So what is dollar cost averaging? This is a good example. I am using the SPY S&P 500 ETF. The dollar cost averaging is example, you investing $1,000 monthly into the S&P 500 ETF. So in June, right, the price is 303, you can buy 3 share. July 3 share. Then sometime you will buy more share. You only buy 2 share in January of 2021 because the price is increasing. Yeah, so after you invest every month, you just buy 1,000 worth of the ETF. Then after a few months, right, your total cost you is about 11,000. After a year, I treat it as 1 year from June 2020 until May 2021. So it's total cost you 11,614. Then you have 33 share. So the average cost is about $351 per share. So by the time that I check, the current value is about 419.22 minus your average price per share means that each of the share you are profiting $67. So times 33 share equal to $2,200. So you just do nothing. You just buy ETF every month. Then your return is about 19.11% in the last 1 year. So dollar cost averaging, the beauty of dollar cost averaging is you no need to care about the charting. You no need to do anything. You just deposit 1,000 monthly and then you just buy whatever share that you can buy. Like this month 1,000 can buy 3 share, then I buy 3 share. This month 1,000 can buy 2 share, then I buy 2 share. That's all. Yeah. You don't need to be monthly. Sometimes you can quarterly, every 3 months or 4 months, or you feel that you too lazy, you want to do every 6 months, is also completely fine. Just that you have to do it. Stay in investing, then your money will not be killed by the inflation. Okay, this is another strategy. Buy in the so what does it mean that you have to look the chart a bit. So you have to open the chart, then you can see that there is a support level in those moving averages, right? So you have to buy in the pages. Let's say you allocate your money 25% here, 25% here, 25, 25, so become 100%. So you just put the order, there is a limit order with a good deal cancel. You just put there, then you don't need to do anything. Wait for the price to retrace, then to trigger your order, then you will automatically buy. So you don't need to do anything. Just maybe every once a week or 2 times, or maybe 2 weeks 1 time, you just go inside and then you just adjust your order to match with all the moving averages. Then you just close your chart, then you just go and do whatever you like. So the order will auto trigger. You don't need to care about it. Yeah. So these are the 2 strategies that I found out is very effective and then very efficient also for the ETF investment. If you like the video, you can subscribe to our channel, and then thank you very much.